We've talked about breaks. Let's see what breaking really means and what conditions we consider in a break of structure. But before everything, this is the general anatomy of a candlestick formation. On the chart, they might come in different sizes and shapes. However, they become an important subject when we are talking about breaks and liquidity concepts. Structure and liquidity are two inseparable parts of the market. Many liquidity areas find meaning through structure, and many structure levels become invalid with liquidity concepts. It can be hard to understand, but we'll cover it all today. Now, how does a breakout occur? A breakout occurs when a candlestick clearly breaks the previous market structure with the body. This means that if the price can close a visible amount, like a couple of pips above the previous level, we would have a so-called break of structure. But here comes an important point. How can we ensure this break is valid and not just a liquidity grab? In case of a fakeout or liquidity sweep, the price immediately gets back into the range. So let's make our concept more advanced. If the price wicks above the previous market structure and closes back inside the range, we won't have a valid breakout, which we previously discussed. But in order to have a valid break, the following candle needs to close above the previous one. This is a strong sign that the sellers have failed to push the price back inside the range and the buyers are in control. Similarly, a double confirmation for a break of structure with a closed body would be to wait for the following candle to violate the highest point of the previous candle. This indicates a strong continuation momentum to the upside rather than a liquidity grab. Remember, everything we discussed here is applied to the bearish scenario as well. Now let's move on to the next topic, reversals. We previously mentioned that we have two kinds of market behavior, a trending and a ranging market. Sometimes it's hard to identify the direction of the market, or it feels like the price has been trapped in a box. The subject of the ranging market is out of the scope of this video, so let's focus on when an uptrend turns into a downtrend and vice versa. Or, in essence, when should our overall bias be bullish or bearish? As we mentioned earlier, the break of an origin creates a change of character. A breakout occurs when a candlestick closes a visible amount through a level of market structure. So, first, we must locate the sources to identify the reversal points. But here is an important point. Scales matter in identifying the change of character. For instance, here both of these levels are considered a source because they have broken above the previous market structure. However, we won't consider this break a valid change of character. The reason is that the failure of such a small movement is not supposed to be considered a reversal of the trend. So here is another rule for a change of character. A valid change of character occurs by breaking below the lowest point of the latest impulsive move that is at least half the size of the previous one. For example, look at this chart. If we apply the concepts of market structure, we would have three impulsive moves like this. All of them have created a new high, so breaking below the source of each one is considered a change of character. But look at the size of the third impulse. It's barely even half of the previous move. So in this case, if the price breaks below the swing low, we won't consider that as a valid change of character. So basically, we compare the scale of the latest impulsive movement with the previous one, and it should be at least half the size to consider it a valid reversal. So if the previous move is 50 pips, the latest impulse must be at least 25, or else we have no valid change of character. Here in the bearish scenario, these are our impulsive bearish movements. Breaking above this is considered a valid change of character because this impulsive movement is obviously larger than half the previous one. Keep in mind that we always compare the latest impulse with the previous one on the chart. However, when trading reversals, there is another trick to avoid trading a fake change of character, and no one talks about it. Imagine a high, a low, a higher high, and a higher low, a clear uptrend. Here is the latest low. Now, if we observe a candle breaks the latest low and closes below it, it seems a change of character, but sometimes, not all the times, this is a fake break. This break can be a deep pullback to grab liquidity for the next impulsive move, and we must avoid trading such reversals. In fact, to confirm a more trusted form of change of character or reversal, we need to see that this uptrend is weakened by supply power. So to confirm a reliable change of character, we must see a lower high first. Formation of a lower high before this break is the exact signal that we need to confirm a more trusted reversal. For example, here we have a low, a higher low, and a higher high. It's a clear uptrend for now. This is our latest low. At the next move, we observe a break below this low, and when this candle is closed below the latest low, it seems a change of character. But we are not going to trust it. So let's continue. Now watch this low, a higher low, a higher high. Again, a higher low and another higher high. Another higher low and higher high forms, so we are in an uptrend yet. But now, take a closer look. After this clear confirmed uptrend, we can observe this candle closed below this low, but this time we have a confirmed lower high. Now we can tell the uptrend is weakened, and this is a clear and trusted change of character. No matter what your entry strategy is, trading along with the dominant market direction will instantly improve your win rates and risk-to-reward ratio. Now, one of the most critical concepts in identifying the